Thanks, Roberto. Appreciate you making the time.
Yeah, it's my pleasure, Eric. Thanks for having me.
Great, great. So I thought I'd start off with just a brief introduction to yourself and your team at Marret. Give us a little background of yourself and your group, and talk about your investment philosophy and what it is that you guys do.
Sure. Thanks, Eric. So Marret, we're a fixed income specialty shop. Primarily, we do actually a lot of liquid alternatives or hedge funds for both institutional and retail clients. I'm the CEO of Marret. I've been with Marret probably going on 9 years now. The firm itself has actually been around since 2001. Again, we started off really as a high yield shop, but really grew and broadened our asset base to cover government bonds all the way to investment grade and high yield, both from the long, short, as well as traditional fixed income, but as well as some alternative strategies that are probably familiar within your portfolios. I think what really differentiates us relative to your typical fixed income manager is really that the ability of the alternative side. I think really, if anything, this period in the last 3 or 4 years has really showcased why it's important to have a little bit more active management with regards to fixed income. And when we talk about alternatives, Eric, just to be clear with your investors and yourself, obviously, we're not big users of leverage. Why we like to be alternative managers is just because we have tools in our toolbox that traditional fixed income managers don't have. For your investors, example, if I could just simplify it, the two biggest risks in a fixed income portfolio is either recession risks if you're invested in corporate bonds or bonds of companies, or it's interest rate risk. So when central banks are raising rates, typically that creates a lot of volatility for bond funds in general. We have the ability to deploy tools to hedge both of those risks. So what we want to do is we actually want to use these tools to actually minimize volatility to try to generate some really good risk-adjusted returns for your portfolios and your clients' portfolios, whether interest rates volatility is there or whether even recession risks are high. We're kind of that anchor in the portfolio that kind of helps you navigate through periods like we're going through this year. So we're known for being highly active. We're probably 3-4 times more active than your typical fixed income fund. And I think one of the last points that we'll stress, I think, with your investors is with us, I think when you look at our mandates and you think of fixed income, it's really more than just the coupon or the yield that you're getting from the portfolio. Because we're able to generate some active moves within different periods of volatility, we can add capital gains on top of the yields that helps what we call generate these total returns. So example, the portfolios that you own within your portfolios are probably over the last year, their net of fees are probably 7.5 to 8% net of fee returns. That's not just the coupon. It's because when we see opportunities when either government bonds are cheap, we can add government bonds, then subsequently take profits. If we see more recently, if corporate bonds become volatile, we can try to enter with attractive prices. Again, just focus on generating what we call total returns, I think is the key with our mandates.
Okay, fantastic. That's great. So now if we can shift to, I'd like to talk about what you guys have been seeing in 2025, and given the market volatility and the geopolitical actions that have been happening. Can you share your perspective on what's happened so far this year and some of the actions that you guys have taken this year?
Yeah, if we look at the start of the year, I think the start of the year, there was a lot of really bullish optimism in terms of risk markets. As you know, equity multiples were 22 times on the S&P 500. Credit spreads, where that's a measure of the perception of risk in the corporate bond market, was at all-time lows, which means, again, just confirms really bullish scenario that was baked into markets on this idea that, hey, Trump 2.0, if you remember the first Trump administration, it's going to be pro-growth, pro-cyclical from start to finish. Look at his first term, it's going to be the same. He's going to give tax cuts and deregulation. We felt that, to start the year, because of where multiples were and because how late in the cycle we were, and given where central banks were in terms of the rate cutting cycle, there were still some risks. So we felt that actually the beginning of the year, we were anticipating volatility in the first half of this year, so an economic slowdown, coupled with a valuation reset to reflect the fact that there was the slowing of the economic cycle. But we did feel, though, at some point, probably towards the midpoint of the year, we did feel, though, that even though there could be volatility early in the year, there was probably going to be an opportunity to actually buy risk into a pullback. Because when we looked at the opportunity set, you actually had two things that could work for you. Number one, even though Trump started to focus on tariffs and deregulation, we did feel, though, that next year is the midterm elections in the US, which means he's going to want to have a favorable looking economy and a positive growth path into those midterm elections. So even though he was maybe trying to cause a little bit of a slowdown earlier to maybe get interest rates lower, we did feel that he would be forced to make a pivot the closer you got to the back half of the year. So that's one kind of card that you had in your back pocket if volatility did show up. We felt that you wanted probably to deploy risk. The second thing that we had to be mindful of also is, you know what, the central banks in the US, they're still not anywhere near where the BOC is in terms of rate cuts. There's still lots of cuts that they can do to actually stimulate the economy if Trump actually caused, if there was a cyclical slowdown naturally, or if Trump's policies caused an even deeper cyclical slowdown. If Trump didn't pivot, the Fed had lots of room to cut maybe even 200 basis points throughout the year if needed, but obviously they didn't need to do that. But you had those two big cards working for you that if there was a volatility reset, that could happen. So what actually happened was we were prepared to actually prepare for volatility early in the year, but to buy risk if there was a pullback, and you wanted to own risk going into the back half of the year and into the economic recovery into 26, 27, and 28. Because don't forget, that even though there was a focus early that caused a lot of this volatility in markets on tariffs and immigration, once you get past that hump, then you can focus on the tax cuts, deregulation, and all the onshoring of capital expenditure potentially going into reshoring industries here. You might have a good 2 to 3 years of tailwinds for economic growth once you get past that kind of period of volatility. So what we did within the portfolios is to start the year, reflecting our cautiousness on risk. If you look at the mandates that you own in your portfolios, it was extremely high quality. So I'm talking about, those mandates were anywhere between, call it 70 and 75% government bonds, mostly U.S. Treasuries, because at 4.6 is where we started the year in the U.S. 10-year. There's a lot of room, number one, to collect a yield, which is interesting, but there's lots of room for that U.S. 10-year to rally if there's some sort of softening of economic data. We did have some credit in the portfolio, but what we did, though, was we kept it really, really short dated to give you some really good yield without taking too much recession risk. So the overall portfolio was extremely high quality, but yet still yielded almost 6% in terms of a yield for your portfolios. On top of that, we actually felt that there was an opportunity to actually put some hedging in place. So we were short what's called credit index default CDX spread, CDX futures. It's kind of like buying insurance against a recession in the corporate bond market or a volatility in bond market. So we bought some insurance against volatility in corporate bonds. And the other thing that we did was also we put in what we call a put spread on the SPYs or the SP 500. So we basically bought insurance against the drawdown of the SP 500 at a very cheap price. And all of those things actually allowed us to generate some pretty good returns, even though the markets were volatile into April 7th. Now, April 7th, obviously, really big valuation correction. And in fact, if you look at the futures, the overnight futures, you had a drop of the S&P 500 of 22%. So the actual underlying futures market was in a bear market. Don't forget, tech stocks were down 27%.
Yeah.
Small cap stocks were off 32%. You had the US 10-year rally from 460 down to 380. The US 10-year hit our target where we felt that they were already starting to price in a pretty deep slowdown. Plus, you started to get credit spreads actually widened in terms of volatility and high yield bonds. They finally started pricing a slowdown, which we haven't seen in the last couple of years. So in our view, we said, hey, you know what? The portfolios no longer should be 70% government bonds. They shouldn't be under risk credit. We felt that, you know what, because when you understand what's been happening, the volatility that you saw when you saw that big correction in equity markets, it wasn't because of something structural that broke, meaning like in 02 and 08, where there was some over leverage in the system, either corporate balance sheets like the tech bubble or consumer balance sheets like in 08 with the real estate crisis. It wasn't something systemic that was going to take down the whole system that could cause maybe 40 or 50% drops in equities in our view, right? Neither was it a cyclical slowdown, which is, the Fed raises rates too much and it causes a cyclical deceleration of growth that's rapid, and you start to see unemployment start to rise. This was actually what we call a third type of slowdown, which is called an event-driven slowdown. So this is like 9/11, SARS, COVID,
Yeah.
but this event was Trump. So basically, when you understand event-driven slowdowns, typically the drawdowns in equities are 20 to 30% drawdowns on average. They don't get to the 40, 50% drawdowns. So you had a 22% drawdown in equities. You had a massive rally in government bonds. We said, you know what? Let's get our government bonds down now. So we went from, call it 70% government bonds down to 20% into this rally, into the 380. And we took up the credit exposure by 35 to 40%. So we still had a little, we weren't fully risked yet. We still left ourselves another 20% of risk to buy if spreads continued to widen, or let's say the S&P 500 decided to draw down even more. Obviously, we're more fixed income focused, but that's just when you get the S&P 500 drawing down, that means corporate bonds are selling off. We said, you know what, let's leave ourselves 20% risk left in case there's more volatility, but be prepared to buy that, because at that point, the overall high yield index would have been yielding close to 9%, given the move. Yeah. And that is a really good yield considering the overall index is high quality, right? So we were able to take advantage of that, add risk to the portfolio kind of towards April 4th through the 7th. Being comfortable, I said, hey, if it keeps leaking, we have some dry powder to deploy, but you shouldn't stay on the sidelines too much. You shouldn't be over conservative. And guess what happened? Obviously, we've had one of the biggest risk rallies ever in terms of speed. If you look at the speed of this recapturing of that move, if you look at the charts and you pull back, this is as fast as you've seen even during the COVID recovery. The drawdown and the recovery over a month and a half is fast. Yes. Credit spreads retightening too. It's as fast as you've seen in any other periods. And you know what? We felt that, the market has given us a gift. We were able to buy risk cheap. It's a rally completely. We feel that, we're probably we need to take some chips off the table here, because you've had this big drawdown in risk without the economic slowdown. It was a Trump-induced drop. There is still risk, though, that the economic data starts to roll over the next couple of months. So if you've got a valuation correction and a big rally before the hard data starts to roll over from labor, maybe we should be going back. Let's lock in these gains here. So we basically sold, call it 25 to 30% of the risk that we bought overall. We're also, by the way, we think that government bond yields can stay volatile. There's a lot of volatility that can happen, which means that we don't love government bonds as a core holding in the portfolios as you've seen them before, because we're dealing with deficits and inflation scares in the U.S. We prefer to hold Canadian government bonds right now, but even that, we're keeping the durations short. We do think that there's going to be some volatility still, that you could trade government bonds for tactically, but don't use them maybe as a core. But we do still anticipate that you probably long-winded answer to get through 2025, but we do think that there might be one more period over the next couple of months. And tomorrow, on the Friday that we're recording this, you're going to get the non-farm payroll number. And it's an important number, because the market is trying to understand, is the labor market starting to buckle here because of all this uncertainty that Trump's causing? Once the market starts to what we call the hard data, which is GDP, it's consumer retail sales, it's the labor market. Once that starts to maybe roll over to signal the weakness that Trump has caused with his uncertainty, we think that could create one last opportunity for a risk to maybe have one more pullback.
Okay.
And then you need to buy it, in our view. We think we're waiting for, we've taken risk. We added risk April. We've taken risk off in this huge rally. We're ready for risk to kind of sell off a little bit here, to buy it. And then we want to be holding, I think, for the recovery trade. And again, the nice positive policies going into 26, 27, and 28, because that's really where you get a lot of tailwinds that come through the tax cuts, deregulation, the clarity around trade tariffs will be done. And you go through this period of, okay, we're now, there's more certainty. So I think we're pretty excited here. I think we've done a pretty good job through 2025. I think we've preserved a lot of optionality going into 2026. And you know what, for the portfolios, if we don't get one last risk drawdown, well, guess what? The portfolios are yielding a 6%. We've got, maybe call it 30% government bonds in there. It's 70% credit. So the portfolios will be fine because of the yield. And you're not going to be hurt in the portfolios because we've already gotten, put it this way, beginning of the year, maybe we are 70% U.S. Treasuries. Now we're 5%. Right.
Yeah.
So we're the portfolios are already well protected in case there's some interest rate volatility that persists.
That's great. And 6% yield right now, it's pretty attractive considering we've seen
Oh yeah.
cash
Yeah.
yields drop down to sub 3%, right? So,
Yep.
and
Exactly.
on the risk adjusted return that you guys offer, that's a very attractive yield. And it just, the scenario you just walked us through speaks to the importance of why clients need a diversifier in the portfolio, right?
Yep.
Why we need something to offset the equity risk. And it's really interesting to hear about the flexibility that you guys have in your mandate as compared to a more traditional fixed income mutual fund structure, which is pretty limited, or a passive bond ETF structure, which will buy the good, the bad, and the ugly, right? So
I think that's the challenge for passive bond ETFs is the duration management. So the interest rate exposure, the management around that it's passive, right? So they'll have the same exposure whether it's a high inflationary period or a low inflationary. So what you're starting to see is there's a lot more volatility around even government bond yields.
yeah.
And this is just something that passive ETFs are not accustomed to managing through or being exposed to actually, because we haven't seen inflation risk like this since like the 80s, right? Before all these products were passive products were probably on the market. So we think we definitely we can bring a competitive advantage in terms of minimizing that volatility for clients on the interest rate side.
Interesting, yeah. And you said something that got my attention and just correct me if I heard your statement wrong, but is it right now you seem to be more, you find Canadian government bonds more appealing than U.S. Treasuries?
Yeah, you know what? Just to preface that a little bit, we've already taken our government bond exposure down from, let's say, again, beginning of the year we were 75% government bonds. Now we're 26%, right?
Okay.
So the 26% that's there, again, it's not because we love government bonds because like the nice part about holding government bonds of longer duration is when you get a recession and you have this big rally in these government bonds. I don't think we're seeing, put it this way, I mean, if there is going to be a slowdown, I don't think we're in the camp where it's going to be a deep recession, right? It's going to be a softening of growth.
Yeah.
But I don't, the amount of deficit spending that's being pumped in, the amount of the fiscal policies that are going to be put in place, the labor markets are holding up. We don't see these really big recession risks. So the need to have a large amount of government, plus you're fighting this worry about inflation and bond supply. This is the biggest risks, or I guess the biggest headwinds are coming actually from government bonds. But where we do like government bonds is in countries where we think there's a lot of still downs or high probabilities of cuts. So Canada, we think is still, there's probably one or two more cuts left to do. That 275, they're on hold, but they're ready to react. If there's a softening in the U.S., there's going to be a softening in Canada. It takes time for Canada to deploy a lot of the policies they're going to want to deploy to get the Canadian economy and to diversify trading partners. It takes time, right? So we are still susceptible. We have a consumer that is over-levered to the real estate market. We have we have the unemployment rate that is closer to 7% here. So the risk of wage deceleration in Canada, if there's some sort of shock to trade, is higher. So we do think the Bank of Canada will likely have to respond because we're just a more cyclical type of economy. So if we do, again, of the 26% government bonds that we do have, call it 80% of it is in Canada, and it's on the short end. So it's like 2 years, because when they start cutting rates, all of a sudden those 2-year government bonds really start to rally because they're held really closely to that overnight rate. That being said, though, if U.S. 10 years actually because we think the risk to U.S. 10 years, because they're fighting different issues than, let's say, Canada's bond market, is that is it possible that the U.S. 10-year, the risk is it could actually climb to 5.25? It's not impossible. I think at that point, though, we probably want to switch our exposure from Canada to U.S. because right now, U.S. is at 4.35 or 4.38 as we speak today. So once you get past that, a lot more, I guess, volatility in the government bond market in the U.S., I think that could be an attractive tactical entry point to get the trade back into the U.S. Treasuries. Again, maybe to ride it for a 50 or 75 basis points rally for some capital gains, not because we want to hold these things, for 5-10 years because we love U.S. Treasuries. I think we're more of in a tactical mindset to use them opportunistically. If the markets start to price in extremes, that's where we'll step in and maybe swap them out. Yeah.
Okay, so that sounded great. So, speaking of how you mentioned the Bank of Canada has the potential to make a few more rate cuts, could you share your insights and your thoughts on issues you see within the Canadian economy, how the Bank of Canada is focusing on maybe the housing sector, how right now in Ontario specifically, we're looking at elevated unemployment rising. So, because those are, I know the Canadian economy, I would think is a bit more interest rate sensitive than the U.S. economy is. So I'd be really curious to have you shed a light on your perspective on that.
Yeah, you know what? Like, I think it's important because a lot of times, our investors, we listen to Bloomberg in the morning or we see these headlines. It's all about the U.S. economy, and maybe we kind of think we're equivalent or the same. They're our neighbors, but the economy in Canada is very, very different from the U.S. The Canadian economy is what we call an open economy, where we rely on global trade. So if you think about, the majority of our GDP is done through exports of commodities, raw materials, to emerging market countries for emerging market projects, or we produce goods that go into inputs into, let's say, the auto sector, into the U.S. So we depend a lot on global trade to power our economy. And what's left of our domestic economy is really fueled by the real estate market. Okay, so when you see what's going on with Canada, and that's the reason why, the U.S. started their rate cutting cycle, they stopped. The Bank of Canada just kept continuing down to 275, while the U.S. is still at call it 450, 475. It's really this reflecting the fact that, we are that much more susceptible. And I think that you're starting to see that, earlier on, even as the unemployment, as you touched on, Ontario is getting hit hard, not only with higher unemployment, but if you look at the real estate transactions, there were 7 months in a row, record low transactions. You'd have to go to the depths of some crisis to see how low the amount of transactions are going on through the real estate market. And it's just housing affordability is just, there's supply and affordability, but mostly affordability is just not there anymore, right? Even though rates have come down, what you're starting to see is two things. Number one, wage growth has renormalized back to pre-COVID. So housing prices are still elevated. They're not low enough where the rate given the house prices, when you translate that into a monthly payment, you're not getting that wage growth enough that people are comfortable taking that risk to take on that property, right? They're demanding a lower price and it's not happening. The other thing is, if you're in an industry that's either related to real estate or related to anything regarding trade, so commodity, steel, aluminum, autos, how comfortable are you to move in this kind of environment with such uncertainty, right? So basically, the real estate market, other than there's certain economies, like in Quebec, so far the transactions are decent, but call it it's a very specific market. But in general, if I look at Canadian real estate, you're just starting to see our economy, our wages are exposed too much to global trade. We are an over-debted consumer relative to the U.S. Like, our debt to GDP ratio is like 180% in Canada, while it's like 125, 130 in the U.S., right? So it's we're an over-levered, kind of relying on global trade. So, if I look at the Canadian economy, I think the Bank of Canada has done their best to try to get a way of anticipating that relationship of a slowdown because of global trade. So they've done a decent amount of cuts here, right? I mean, they're close to 275, but I think by year end, markets are pricing in maybe 1 to 2 cuts, a little more than 1 cut. So you get down to 250. I would think that actually the 250, 2.25 to 250 is likely where they felt the neutral rate for the Canadian rate was going to be, like their eventual long-term terminal rate. I think that's probably they're in their zone, and they've done it quickly here in anticipation of these slowdowns. So I think what they've done is they basically said, hey, look, we recognize that there's balances to risk here, right? Yes, we have an economy that is definitely more sensitive. So we think that we've provided enough cuts, and we kind of almost like insurance cuts to provide at least a decent credit environment for credit growth. while we still see what's going to be happening here. Because if you listen to their press conference yesterday, it's still just a lot of high uncertainty here, right? And
Yeah.
on top of that, you're having some inflation numbers coming into Canada that were like, the data is coming in very mixed in terms of you're getting some pretty, I would say, not great employment data. If you look at the last 3 months in terms of employment change, it's negative, right? You had
Hmm.
1 month it was negative 32,000. Last month it was positive 7,000. If you look at the last 3 months, it's actually negative job growth. You've
Yeah.
had the unemployment rate go now closer to 6.9. We get an employment number in Canada tomorrow. Again, it's projected to be weak and an unemployment rate to go up to 7% officially. That is kind of an uncomfortable place for the unemployment rate to be. So I think what they've signaled is, hey, look, we're ready to act if we need to. We're definitely. It doesn't mean that we're on hold indefinitely. It just means for now, we need to see how does inflation react, how does the labor market
Hmm.
react, what is the clarity on trade. But I think there, from the labor perspective, there's still some cuts that can be done definitely if the labor markets start to slip.
Yeah.
From a growth perspective, you started to see a lot of front running of exports, which actually propped up the Canadian economy because there was a lot of early imports before tariffs got on.
Yes.
I think you need to be watching now, what does the GDP number, because it's been basically flat for like 3 months. After kind of you've had this surge in getting ahead of the tariffs by importing a lot of Canadian goods, let's say to the U.S. ahead of
Hmm.
tariffs, is the consumer actually going to hold up?
Yes.
Is uh, not just the U.S. but even the Canadian consumer. Is the Canadian consumer going to hold up in the face of these tariffs? Will that spending on services hold up? I think this is what the Bank of Canada needs to see. So growth, and then also how does the inflation dynamic start to change? Like, do companies and again, I think this comes down to what we call corporate pricing behavior. Is like, if
Yeah.
they're getting higher costs, these Canadian businesses, how much do they pass on to the consumer? How much do
Yes.
they eat in terms of margin pressure?
Hmm.
Or, conversely, okay, if I don't pass full it on to the consumer and I have to eat some of it, then to protect my margins, do I start to lay off people? Right. So
Yeah.
that's what you have to be mindful of. And that's why I think, our portfolios want to be mindful that there could be some slowdowns in the Canadian economy as well as the US economy, which
Hmm.
is why we have more exposure in Canadian government bonds, because we think that the Canada is much more susceptible to these slowdowns and have the ability to respond, because our inflation dynamics a little bit better than in the US. Plus, the Canadian currency is actually appreciating a little bit right now relative
Yeah.
to the US, so that helps us with our importing inflation at a cheaper price. So
Hmm.
again, we have a few um, I guess tailwinds or positive things for us to keep cutting relative to the US.
Yeah.
But again, I don't think you could go through this soft patch of the Canadian economy, but as the US starts to kind of want to reaccelerate into 26, I think Carney and Trump are already talking about, there's already, look, they didn't retaliate. Like they put they brought up aluminum or steel tariffs to 50%, and Canada said, hey, no, we're not retaliating. We're talking. So we anticipate there's going to be, a change to the USMCA trade agreement, obviously.
Yeah.
So there's, we are integral to each other's economies, and we think that there's some light, definitely some clarity that will be done, and you want to be kind of probably into that recovery trade. And on top of that, not just from the US kind of reigniting their growth engine, I think that Canada, with Carney coming in, some of the projects that he's going to be focused on is freeing up interprovincial trade. It's getting
Yes.
infrastructure projects up and running. It's creating more of a focus on technology, AI, the infrastructure around that whole industry. There's going to be fiscal spending done in Canada that will also be kind of positive for an impulse to Canada once you get over the soft patch. But again, because
Yeah.
it takes time to actually announce and deploy these things, um, I think there's some really positive things, I think, for risk markets.
Yes.
There's just a little bit of transition that you have to go. There's a little bit of hard data pain that I think
Hmm.
that has to get printed. They're already working on the responses to that, so it's not going to be a surprise when those numbers start to print, right?
Yeah. And
So
the
I
question
think
is, can the markets see through that
I
hump,
think
right?
they are, to be
Are they going to
honest.
interpret it as something bad, or are they going to interpret it as we anticipated this hump, but let's price in what's coming in after that? That's
I
the
think,
question, right?
and I think that's why you have to be cautious on government bonds and
Yeah.
yields, because if there's, let's say there's much more spend, like, by the way, Canada, like everyone know, like if you've heard in the news on the US, they have what's called a deficit to GDP ratio of kind of almost 6 to 7%. That means they're overspending relative to their own internal GDP.
Hmm.
So they actually have to borrow a lot to finance all of their spending.
Yeah.
Canada's deficit to GDP is much smaller. It's like
Okay.
1.5%. They've got
Yes.
lots of room. They're not in that danger zone. So there's going to be, um, I think, more supply for Canada government bonds at some point.
Yeah.
But that being said, these are positive for Canadian growth, which is
Okay.
why you don't want to necessarily want to holding, let's say, 10-year Canada government bonds, but it's okay to hold 2-year Canada government bonds, because a lot of
Hmm.
the volatility of that fiscal spending that's going to be done in Canada will affect what we call the long end of the curve, which is why you hire bond managers, to understand what parts of the bond market should you be holding, given whether inflation, growth, or fiscal deficits are kind of whipping these bond markets around. So,
Okay.
yeah, so I think there's lots of positives from a growth perspective. So, which is why I think, generally speaking, you want to be focused on credit. And
Yeah.
I think because of the bond supply, deficit spending, have a really active management around the government side of government bonds to generate some pretty good alpha.
Okay. And speaking of, just on the topic of Canada-U.S. relationships and differentials, uh, we get asked quite a bit, and it's hard for us to really give an answer. And I thought a fixed income manager like yourself can have some better insight, but we're always getting questions about currency, that the
Yeah.
CAD
Oh yeah.
USD
Yeah.
relationship, because a lot of our clients, rentarees, they either own
The
properties in the
snowbirds. Yeah. Yeah.
States, they own properties
100%.
in Florida, South Carolina, Arizona, or they're just traveling to the States, right? So, because correct me if I'm wrong, but I thought that the theory was that, or the fear was initially, if the BOC, Bank of Canada, cuts rates much faster than the Federal Reserves, and there's a big differential in the two interest rates between the two countries, that would put downward pressure on the Canadian dollar. And I
Yes.
think
Yeah.
at first we did see that, but
Yes.
then after the Trump administration came in, we saw, I would say downward pressure, but a fall in the
Uh,
value of the U.S. dollar and appreciation of the CAD dollar. So
Yeah.
what's the outlook on your
What's
perspective
going
on
on there,
this?
right? What's going
Yeah,
on?
yeah, exactly. How do
So
we
listen,
explain
I
this
mean,
to clients?
to your point, I mean, often, like specifically the Canadian to US dollar, that currency pair is driven by two things. You spoke about one of them. One of them is the interest rate differentials. That's usually the biggest driver, but the other driver is also oil prices. So it's,
Okay.
we call the petrodollar, right?
Yes.
And generally speaking, you have these are the two biggest things that drive how these currencies fluctuate. So I think, to your point, what you saw was, hey, the Canadian dollar, the Bank of Canada, much more aggressive with the rate cuts relative to the US. Um, so you saw the Canadian dollar actually weaken quite a bit, probably up until the end of last year, right?
Yeah.
Or maybe at the beginning of early this year. Um, but it was a really big move. Like if you look at the range, if you look at the 5-year, you know, you got to levels where this is the lowest CAD to USD. I mean, that run was a big move, right, over a 5-year period. So how much of already was that baked into the move already in the CAD USD? I would say that, and then subsequently we've seen this big rally of the Canadian dollar relative to the USD. You've had some oil prices now, because there were some announcements to, let's say, um, OPEC countries specifically. Um, they they started announcing earlier on lots more bond oil supply that was being announced, because basically at the same time, this was also at the same time they were doing that, the Canadian dollar was weakening with oil prices weakening, because there were some certain OPEC countries like Kazakhstan and Iraq that were overproducing, and basically the larger bodies, the larger countries wanted to punish them and basically get oil prices lower. What you're starting to see is now they're kind of taking back in terms of the oil supply. So oil is actually starting to recover here. At the same time now, since April. And what Trump has done is that when you start talking about lowering global trade between countries, and this is kind of I don't want to go too in the weeds with this, but typically speaking, the more a country has, let's say, what you call a trade deficit, like let's say China sells a bunch more stuff to the US than US sells to China. Typically what happens is China basically has all this revenue that they've gotten from selling stuff to the US. They don't convert it back to the US to Chinese renminbi. They don't
keep it in
buy, they
USD,
keep
right?
it in US dollars in US Treasury bonds.
Yes.
The whole liberation thing where Trump was really confusing is saying, hey, we don't want to have any trade surpluses with any country. So we want to have like, which is basically impossible.
Impossible when you got a
but
consumer economy like the US, right?
it's just mathematically impossible. But if he was going to get to the point where that was actually what he was trying to do, well, that means there's going to be less demand for U.S. Treasuries. So you saw U.S. government bond yield spike. And conversely, though, if you have less surplus, what they call capital surpluses, you don't hold as much U.S. dollars. So it was a global, if you look at the US dollar, it weakened across all global currencies. So Canada, the euro, the yen. And I think the whole idea is, hey, like, look, if we're gonna have less demand for U.S. dollars, because it's a win-lose game, right? If the U.S. dollar weakens, the other country's currency appreciates. So you had this effect where you had basing of oil prices. You had basically this idea where you know what, there's going to be less bid overall for U.S. dollars, so higher demand. So we're going to trade less with the U.S. Maybe we'll diversify more trading with Eurozone. Canadian dollar could appreciate relative to the US dollar. And you're in this kind of, and also, by the way, it's just, the Bank of Canada was already close to their terminal rate. So, I mean, you got to the point where you had a basing of the Canadian dollar relative to the USD, probably in terms of interest rate differentials. We don't think markets were going to price in that Canada was going to cut to 1% in the US dollar and the US not cutting from 450, right? So that from then on, I think the interest rate movements between the two countries will probably be a bit more symbiotic. And then you've had this rise in Canadian dollars, right, relative to the USD. So where do we go from here, basically, is, it's a function of both of those things. I think that, I think there's a chance, like there's this whole talk about how the US dollar is going to be losing their reserve currency. I don't know if you maybe heard this before in the news and whatnot. To be honest, the US dollar had strengthened dramatically because of how high they took their interest rates relative to everybody else. Plus, they had much better growth than all these other. So it got the DXY, which is the global index for the US dollar, had reached some pretty high levels.
Mm-hmm.
It's come off, right? So now it got to 118 or 119. It's now back to closer to 99, but closer to 100, right? To replace a currency as a reserve currency, you have to replace it with something else. You can't just decide it's over. And so is it going to be Bitcoin? I don't think so. Is it going to be
BRICS?
Is it going to be the euro?
Yeah.
I don't think so. These are cyclical types of currencies. The yen is not a non-cyclical, but it's not big enough, So I just,
that's the Japanese yen you're referring to?
Yes, the Japanese yen. I don't think the U.S. is going to stop as being the top consumer in the world. So I just think that, there's going to be capital surpluses required to own U.S. dollars. So did it take a hit or a dent? I think so. If it is a big structural change to another reserve currency, I don't think it happens within a year. I think you need to have, is it Bitcoin one day where it's not as volatile and whippy and it's not an early adoptive type of asset? Maybe, but I don't think we're there. So I just don't think there's another. So I think that there's just going to be probably a little bit more volatility than people are accustomed to. But I don't think it's the end of the US dollar as a reserve currency as we speak today or even the next year. So I would say, hey, you know what, like, if you think about it this way, if you're a Canadian investor and the US dollar is actually depreciating, that means you can buy your US stocks cheaper in Canadian dollars.
But it's like what we explain to our clients all the time is similar to dollar cost averaging, where you're buying into a portfolio consistently and reducing your average cost over months, spread it out.
Yeah.
We think that we can achieve the same thing with CAD to USD conversion by consistently converting over a cycle. From CAD to USD, you're going to bring down your
and there's
conversion
companies
costs.
and sectors that aren't anywhere else.
Yeah,
They're made in the U.S. I mean, you could argue that, okay, you could probably replace financials in the U.S. for European financials.
yeah,
There's going to be probably some interesting defense contractors in Europe, maybe. But when it comes to AI technology, they're going to continue to lead the forefront on that. And
yeah,
I think that's going to be a big driver of growth, and that's exactly part of the Trump agenda, which will
yeah,
kind of lift all ships, right?
yeah.
So.
And so stronger USD, and unfortunately, I think Canadians will always be paying a bit of a premium when traveling down south.
Yeah, yeah, a
We'll
bit
see.
better than before, though. Bit
Bit
better
better
than
than
before,
before.
right?
Right. Yeah. So, anyways, Roberto, today's been fantastic. It's been really informative, very insightful. We appreciate your time. As you know, we're avid supporters of your strategy, and we will continue to be so. So, once again, thank you very much, and we greatly appreciate you coming out.
Happy to do any time, and we appreciate all the support. Thanks, Eric, and thanks, everyone.